Good morning. Welcome to this video. As a part of Guide to International Business Introduction to Trade Finance series, in this session, we talk about trade finance. We will introduce trade finance, especially with reference to international trade. Trade finance is important because it plays a crucial role in facilitating international trade. It facilitates cross-border commerce. It helps global economy. It consists of, or it's involved in, or is helped by various financial instruments, products, and services that enable the corporates to mitigate the risk that they face in international trade, to secure funding for their cross-border transactions, and to conduct these buy-sell actions in a more efficient and effective fashion, venture into new markets, extend the payment terms. This session also talks about the global trade, the key instruments, and the emerging trends. What is trade finance? Trade finance refers to the financial services and products, the instruments that support international trade. The International Chamber of Commerce defines trade finance as a financial service facilitating the real economy, enabling businesses to finance, to monetize, to mitigate the risk, to settle the trade flows, and thereby supporting the movement of the goods and services regardless of the term or payment maturity, both internationally and domestically. So, trade finance is a financial service facilitating the real economy, enabling businesses to finance, monetize, and mitigate the risk and settle trade flows. Trade finance is an activity that supports the movement of goods and services. It enables performance regardless of whether it is at site or at 720 days, and it helps both domestic and international trade. The scope of trade finance includes multiple aspects or angles. One is to provide liquidity to the exporter and importer. Another is to provide risk mitigation associated with the trade transaction across the border. One more could be the facilitating a security for the payments, that's securing the payments, and then offering credit and insurance services. And finally, it could also involve supporting supply chain operations. What is the importance of trade? Trade is essential for the smooth functioning of the global commerce. According to the World Trade Organization, more than 80% of the world trade relies on some form of trade finance from some financial institution in some capacity or the other. So, trade finance is critical to international trade to enable cross-border business. What are the aspects? One is its role in overcoming geographical and cultural barriers. Another aspect of importance is that it helps in managing cash flow challenges. Sometimes there's a shortfall, sometimes there's an excess. The third is trade finance enables expansion into new markets. And the fourth could be complete or compete effectively. Complete your products availability in all the markets by competing effectively with the local companies on an international or a global scale. By providing financial support or risk mitigation tools, the trade finance from the banks and financial institutions help to bridge the trust gap between the importer and exporter, the buyer and seller in different countries from different cultural and economic backgrounds. This fosters economic growth, this fosters global economic growth and cooperation, because today every country is interdependent. Why trade happens, we will see in another session. Who are the key players in trade finance? Most importantly, the exporters and importers are the key players in trade finance. The exporters are the sellers. They are the corporates or the companies or the businesses that sell goods or services to foreign buyers. They seek security for their payment and they need working capital. Importers, they are the entities who purchase goods or services from foreign suppliers. They require assurance of the quality, quantity, timely delivery of the goods or performance of the services. The banks and financial institutions, they provide various products and services, the instruments like LC, BG, and funding. Export credit agencies. Now, export credit agencies are those which are mostly backed by the government and offer credit insurance against the political risk. They provide guarantee to support the national companies. They ensure that the risk of overseas country is eliminated to a large extent. Insurers. Insurance provide Insurers provide protection against various risks associated with international trade. They cover not only the risk of theft, pilferage, and non-delivery of the cargo, but also cover the political risk and other liquidity risk of the overseas economy. Then comes the most important piece in the puzzle in an international trade: the freight forwarders, logistics providers, the carriers, the airlines, and the shipping companies. They facilitate the physical movement of the goods and play a role in providing documents that evidences movement of goods or title to the goods or control of the goods. Now let us turn our attention to some of the trade finance instruments. What are the common instruments? The LCs, the BGs, and the collections. Trade finance encompasses a wide range of financial instruments. These instruments are designed to address specific needs of customers in different scenarios. The letter of credit or a documentary credit is one of the most widely used trade finance instrument. The LCs or the DCs provide guarantee from the buyer's bank that the seller will get the payment upon presentation of complying set of documents. When we say complying, we expect certain set of documents in a certain format, evidencing certain content, having met certain terms and conditions, and the presentation should happen within a given period of time. What it offers, the key features are: it provides payment assurance to the seller, it enables the banks to verify the documents presented, and the terms and conditions can be mutually negotiated between the buyer and seller and acceptable to the bank. What are bank guarantees? Bank guarantees are payment guarantee like advance payment guarantee or a performance guarantee or even a bid bond or a shipping guarantee. They provide assurance that the contractual obligations will be met by the party, and in case one party is harmed because a party is not met the obligation, they can claim under the guarantee from the party who had potential to create that harm. What are documentary collections? There are DP and DA collections, documents against payment and documents against acceptance. In this method, the exporter's bank and the importer's bank act as intermediaries and they exchange the document against the payment or the promise. So these trusted intermediaries play a middleman between the buyer and seller who do not know each other. Let us look at the other methods of international trade settlement. One is open account, where mostly it is risky for the seller because the seller has to send the goods in advance before getting the money. There is an advance payment method where the buyer has to pay in advance before getting the goods or seeing what is being delivered. This is risky for either party. Advance payment is risky for the importer, while open account direct payment is risky for the seller. Factoring and forfeiting. These allow the exporters or the sellers to sell their receivables post shipment to the financial institution. This improves their cash flow, this reduces the credit risk, this increases their balance sheet ratios. Here, the factor or a forfeiter takes on the responsibility to collect the proceeds from the buyer. Most of the time, the selling of the risk of the receivables is without recourse, unless except for fraud. The export credit insurance protects the exporters against a non-payment risk due to political or sometimes even commercial risk. Then comes the supply chain finance. It enables the buyers to extend the payment terms and ensures the suppliers receive yearly payment because a third party steps in and finances during the buyer financing, seller financing period. Let us have a look at the risk mitigation in trade finance. One of the primary functions of trade finance is to mitigate the risk associated with the international or a cross-border trade where the buyer and seller do not know each other adequately well. So, the trust between them may not be at the satisfactory levels because of the unknown unknowns. One of the risks in international trade is a payment risk, non-payment or delayed payment by the buyer. Then we have a country risk, the political instability or the economic downturn or the currency volatility or the changes in the regulation. Then we have a exchange rate risk where the currency rate will go up and down, fluctuate as against your home currency. Then we have the transportation risk, loss or damage of the goods during transit. Even a strike at the port, which prevents the container to be loaded into the ship or loaded off from the ship, could be called as a transportation or a logistic risk. Now, in performance risk, we also need to look at the performance risk of the parties, the buyer unable to pay because of insolvency or bankruptcy, the seller unable to deliver again because of the closure of the business. These are also some of the risks. What are the risk mitigation strategies? One is to use secure payment methods. One of the risk mitigation strategies is to use secure payment methods. That is a letter of credit or even confirmation of letter of credit. To come down below, maybe documents against payment or avalization of a documents against acceptance. Or if we are having an open account situation, then we should have a standby letter of credit to support that. These are various methods. Another is credit insurance or guarantees. The third could be due diligence on the partners or the stakeholders associated. Is our carrier reliable enough? Is our freight forwarder reliable enough? Is our counterparty having capability to supply these? Is our buyer having a lot of invoices outstanding to be paid or easy paying on time? And then is the mitigation in the form of proper documentation. That is to ensure all documents are compliant when you present so that under LC you get the payment. Most importantly, one should take care of the compliance risk. What is compliance risk? The sanctions, anti-money laundering, KYC related risk. If somebody falls into unknowingly, it could be difficult to recover the payment at the later date. Let us look at the working capital or the trade finance capital management or the funding management. Trade finance plays a crucial role in managing the working capital for the businesses. One of the forms of trade finance is a pre-shipment finance, where institutions provide funding to the supplier for production or sourcing of the materials required for conversion and shipment. Another is post-shipment finance. This offers liquidity to the exporters after the goods have been shipped, but before the payment is received from the counterparty. For example, if you buy under 90 days tenor, then you will be paying after 90 days, and the seller needs money during this 90 days when the goods have been sold to you but you have not paid. That is when the seller will go and ask for a post-shipment finance from a bank. The inventory finance, it helps to optimize the inventory levels, how much you hold, how long you hold, at what cost. The holding cost decides whether inventory finance needs to be or should be availed. It could be for the finished goods holding or it could be for the raw materials holding also at times. Then comes the receivable finance. It allows the corporates to access cash against accounts receivable. That is, goods have been sold, invoices have been accepted, but payment is not yet due. Let us now turn our attention to digital transformation. How is digitization or how is latest technology and fintechs helping the trade finance industry? Now, there is a significant transformation happening nowadays. It is driven by advances in the technology and changing market conditions or market needs. One angle is the blockchain and distributed ledger technology. This offers benefits to trade finance, including transparency, traceability, and transferability on a reliable fashion. This reduces fraud risk because of the transactions are considered immutable. There is only one original at any given point in time, and only one party has a control over the document at a given point in time. The smart contracts help in automated execution of trade agreements. Under a smart contract, when certain conditions are met, certain contractual duties are triggered automatically without any manual or subjective decision. Then comes the artificial intelligence and machine learning. AI and ML helps trade finance in multiple ways. Most important of them is the automated document checking, document processing, document verification, and agreement to pay on due date, that is HONA. This also helps in predictive analytics. Predictive analytics to manage the risk on which geography, which counterparty, what type of risk is your corporate facing at a given point in time, or as a bank, who are the corporates who are dealing in most risky corridors. AI and ML also helps in optimization of the timing of the payment or arranging pre-shipment or post-shipment or discounting of the transactions. Then we have the APIs, which is the application programming interface. They help in seamless integration between the corporate and the bank. They help different systems talk to each other irrespective of the small disadvantages or the defects in the legacy historical systems. The APIs facilitate real-time data sharing. The API facilitates an ecosystem that helps to develop the trade finance solutions for all the parties involved. APIs also enhance customer experience because capability for embedded finance and capability for instant and instant, what do you say, reaction or response from the entities. For example, using API, all the corporates can say what are the receivables that they have, and all banks can decide whether they will fund it and at what rate and for what period, under what terms and conditions. So a potential marketplace for the receivable financing is made easy because of the API, which can bring in all the corporates and all the banks into one platform. Regulatory environment and compliance. In regulatory environment and compliance, the aspect that we look at is within the trade finance arena, it is very easy to understand, but outside the trade finance arena, there is a very complex regulatory landscape. There is a very complex regulatory landscape which needs to be navigated safely. One is the anti-money laundering regulations or know your customer regulations. When you're dealing with a buyer or a seller in an unknown country, it is good for you to conduct as a corporate adequate due diligence on the counterparty. The anti-money laundering regulations requires you to know your counterparty as well as the counterparty's business and ensure that they are in line with your business for the period that you find it acceptable to understand that you don't fall prey to a fraud from an unknown entity in an unknown country. Also, banks are required to comply with stringent regulations on this angle. So, when you enter into a bank asking for a finance or a support for trade, they will definitely ask whether the corporate has adequately complied with the AML regulations, the KYC regulations. Then we have the sanctions compliance. Every other day, OFAC and other entities issue sanctions against corporates or individuals for those people suspected to be acting in against the interest of certain nations. So trade finance providers must ensure that the transactions, the parties, the vessels, the goods, the ports, the places are all screened for compliance with international economic sanctions. Then comes the Basel III and capital requirements. Here, the regulations have certain concessions for trade finance transactions. The Tier 1, Tier 2, Tier 3 capital requirement for a trade finance outstanding in the books of the bank are different. And accordingly, based on the capital conversion factor or the capital consumption, the pricing that the corporate will have to pay for various instruments, depending upon their risk, will also be different. That the corporate needs to keep in mind. The digital laws are also undergoing evolving improvement day by day. The UNICITRAL model for the model law on electronic transferable record, MLETR, has been adopted in certain countries. Certain countries are working in adoption, and once they come up, digital trade will become very easy. Now let us look at sustainability. What is sustainable trade? Many banks and many corporates are interested in helping the SDG goals of the United Nations. Every corporate, based on their CSR or other considerations, have certain mission, vision, values that looks at whether the trade finances, environmental, social, and governance consideration taken care of adequately. So the institutions are developing products that incentivize sustainable practices. Corporates are looking at incentives if they adhere to the environmental social governance principles, or if their trade finance is in sustainable fashion, or if the underlying goods are procured from entities that promote sustainability. So the loans, the green loans or the green bonds, or the finances are linked to the sustainable practices. And this is a circular economy, and trade finance is nothing to be left out from this angle. So in a transaction, the corporates and the banks, financial institutions are required to look at how much of a ESG risk is the transaction posing them, and whether it is worth to undertake based on the risk reward or a cost benefit analysis. For this, due diligence into ESG factors becomes a very important requirement. Let us look at the regulatory requirements also. In EU, there is a requirement that the list has been published, what is called as a EU taxonomy. What is that? The list of sustainable activities which are encouraged. So this influences the trade finance landscape. So certain banks are not interested in financing certain institutions if they are doing in normal fossil fuels, which is not so eco-friendly because of deplenishment of the natural resources. That is one aspect. Challenges and future trends. Trade finance industry faces several challenges from the corporate angle and from the bank's angle. There are also opportunities because the landscape is evolving because of the market demand. Persistent gap is the most important challenge. The small and medium enterprises are always finding the gap in the available funding from the institutions. There is a complexity in the regulation, and it adds to the cost of complying. Technology adoption is slow on the corporate side. So integration of the latest technology available with a bank into the legal system of the corporate is becoming a challenge, a costly and a time-consuming affair. Then comes the most important aspect of geopolitical uncertainties and the trade tension due to tariff war. Now, what is the future of trade finance? How it is going to look like? There is an increased digitalization potential. There is room for automation of the processes. It is expected that the alternative finance provider will grow and help because of the fintech platforms. There will be greater focus on sustainability. The corporates and banks will have ESG consideration for more incentives. The ecosystem will expand because of the technology like AI or API or blockchain. And accordingly, the trade finance that today plays a vital role in facilitating international trade will be able to support more for the global economic growth. These risk mitigation tools will become more efficient, and the working capital will become more cost effective in the days to come because the payment assurance mechanism will get more democratized. As the industry evolves, the market dynamics are changing day by day, and it is critical for the corporates and the enablers to be aware of the changing regulatory landscape. Thanks for watching this video. We will catch up again on another video session.